Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Oil and natural gas remain cornerstones of the global economy, powering industries and heating homes worldwide. Even as renewable energy grows, these traditional fuel sources still dominate energy markets, creating steady demand for investors. Recent shifts in supply chains and global politics have pushed oil and gas prices into sharp focus, offering both risks and opportunities. While market swings can be unpredictable, strategic investments in this sector have the potential for strong returns. If you're considering this space, understanding market drivers is key. Let's break down what makes these investments unique. Understanding oil and natural gas markets. Oil and natural gas don't just magically appear at your local gas station or power plant. Their markets are shaped by real-world factors. How much is pumped out of the ground, who needs it, and the unpredictable events that can send prices soaring or crashing. Let's look at the forces driving these markets. Global supply and demand dynamics. Supply and demand decide everything. When production rises faster than consumption, prices drop. When demand outstrips supply, prices climb. Here's what moves the needle. Production shifts. New drilling tech, like fracking or major discoveries, can flood the market, lowering prices. On the flip side, aging oil fields or underinvestment slow output, tightening supply. Economic growth. Factories, trucks, and power plants guzzle fuel when economies expand. A recession? Demand dwindles fast. Seasonality. Winter spikes natural gas use, think heating, while summer sees higher gasoline demand for travel. For investors, watching these trends helps spot opportunities, like betting on rising LNG demand in Asia or tracking U.S. shale output. Geopolitical factors affecting prices. Oil and gas don't trade in a vacuum. A single headline from an oil-rich region can rattle markets. Key flashpoints include OPEC Plus decisions. This group, led by Saudi Arabia and Russia, slashes or boosts production to steer prices. Their meetings move markets overnight. Conflict zones. Wars or sanctions in places like the Middle East or Russia disrupt supply chains. Remember the 2022 spike after Russia invaded Ukraine? Trade policies. Tariffs or bans like U.S. sanctions on Venezuelan oil redirect global fuel flows. Geopolitics adds risk, but also openings, like buying undervalued assets when tensions ease. Price volatility and its causes. Oil and gas prices swing wildly, sometimes in a single day. Here's why. Speculation. Traders bet on future prices, amplifying short-term moves. Storage levels. Glutted storage tanks push prices down. Low reserves send them up. Weather disasters. Hurricanes shutting Gulf Coast refineries can spike gasoline prices overnight. Policy shocks. A sudden carbon tax or drilling ban shifts long-term expectations. Volatility isn't all bad. It creates trading opportunities. But for long-term investors, hedging, like futures contracts, can soften the blows. Markets might feel chaotic, but patterns emerge if you know where to look. Next, let's examine how companies profit from this turbulence. Types of oil and natural gas investments. The energy sector offers multiple ways to invest, each with its own risk and reward profile. Whether you prefer direct ownership, trading contracts, or diversified funds, understanding these options helps you match your strategy to your goals. Direct investments in energy companies. Buying shares in energy companies puts you directly in the game. These businesses fall into three categories based on their role in the supply chain. Upstream companies explore and drill for oil and gas. Think ExxonMobil or Chevron. Profits rise when commodity prices climb, but costs like drilling leases add risk. Midstream firms handle transportation and storage through pipelines and terminals. Companies like Kinder Morgan generate steady cash flow from fees, making them less volatile than upstream players. Downstream operators refine and sell products. Valero and Phillips 66 benefit from cheaper crude prices, since refined fuels like gasoline often maintain stable margins. Stocks here can swing with oil prices, but strong balance sheets and dividends often cushion the blows. Commodity futures and options. Futures contracts let you bet on oil or gas prices without owning physical barrels. Here's how it works. You agree to buy or sell at a set price by a future date. If prices rise, long positions profit. If they fall, short positions win. Options add flexibility, paying a premium for the right to trade later without obligation. The catch? Leverage magnifies gains and losses. A single geopolitical event can wipe out accounts overnight. This market suits experienced traders, not buy-and-hold investors. Energy ETFs and mutual funds. ETFs and mutual funds spread risk across dozens of energy stocks or commodities. Popular picks include AOP, tracks upstream oil and gas explorers. VDE holds giants like Exxon alongside pipeline operators. USO follows crude oil prices using futures contracts. These funds skip the hassle of picking individual stocks while offering liquidity and lower fees. Just watch expense ratios. Some niche ETFs charge premium prices. That's it for the first part of oil and gas investing, what to know before you buy. In Part 2, we'll explore strategies, potential returns, and how to avoid common pitfalls. Stay tuned. Please comment, like, share, and subscribe for more automotive information like this. Thank you for watching. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.